I'm very pleased to be able to speak to Mr. Stefan Ingves, the Governor of the Central Bank of Sweden, on his interest in Islamic finance. Perhaps you can tell us why you attend the IFSB meeting.
Well, before I took up my present position as governor of the Swedish Central Bank, for many years I was working for the IMF as head of the Monetary and Financial Systems Department. And in that capacity, we were doing a lot of technical assistance and other work in many countries with emerging Islamic financial systems in one form or the other. In those days, we came to the conclusion, and many others with us, that there was a need to create an institution which would be sort of a bit equivalent to, let's say, the Basel Committee. And people in my department were involved in the creation of the IFSB for many years. So I was one of those persons who happened to be there when the IFSB was created. I think it's about some eight years ago. And since those days, we have always kept in touch from different angles.
Do you see Sweden being supportive of Islamic finance?
Islamic finance is not an issue in the Swedish economy presently, but we have many immigrants with an Islamic background. So my guess is that it's just a matter of time before also in our country Islamic financial institutions will emerge in one form or another.
A time frame?
My guess would be, let's say, within the next 5 years. I don't think that there are really any kind of technical obstacles to that. The issue is more finding a large enough group of people getting together where they truly want to produce these types of services in the Swedish economy.
You've had a distinguished career where you've actually seen a banking crisis in your home country. You've headed a bank debt resolution effort in your country in the early 90s and so on. And then you arrive at this present crisis. The rules of engagement, or the rules of dealing with the banking crisis in the 1990s had a lot to do with the rules of capitalism, importance of transparency, importance of bankruptcy as a mechanism for choosing winners and losers, the influence of the market and the integrity of the marketplace and the ability of the marketplace to choose winners and losers. We seem to have taken a whole switch to the other side, and now we're saying that without government intervention, markets can't perform, and that there is the concept of too large to fail has to be revisited again. Give us a sense of where do you think we're moving when it comes to the whole tenets of capitalism?
Well, talking about these issues from a sort of a banking or a banking crisis point of view, the short version of a long story is to say that there's nothing new under the sun. Presently, people sort of argue a lot, like at this conference, about why is it that this happened, what was different this time, and why did we end up where we actually ended up. But I think that the historians over time will find that when they look at this episode, that it wasn't all that different after all. Some of the issues are the same, some of them are different. What's the same is too much leverage. If you end up with too much leverage in the system, in one form or the other, then you have a problem, because when markets go south, you don't have enough risk-absorbing capacity in the system, and that's critical. When that happens, when you end up with a problem in the banking sector, and now I'm not talking about small banks, I'm talking about the banking sector as a whole, then also if you go long time back in time, governments have intervened in one form or another. So some of the issues are different, but not that different.
Well, the 1984 savings and loans crisis in the US, the formation of the FDIC, and then the 1990s crisis and 2000 crisis. 1984, they set up an insurance as the backstop, basically, the Federal Deposit Insurance Corporation. Today, we're talking about bank tax. We moved from insurance to more capital to taxing the banks. Now, what's changed? Why the change in game plan?
Well, it's not so much because It's not so much a change of a game plan, because if you talk about deposit insurance, let's say, then deposit insurance has to be financed one way or the other. And banks have to be charged to pay for deposit insurance one way or the other. If that's called a fee or a tax, we can argue. We can argue about that. But that issue is essentially the same. At the same time, if you look at this present episode, if you spend substantial percentages of GDP on recapitalizing banks, restructuring banks in one way or the other, then clearly you get into a political debate about where's the money supposed to come from? Who's supposed to pay for this? How do we actually go about it?
Right. As a central bank governor, are you in favor of a bank tax model?
It's a bit too early to tell, because it really depends on how it is put together, because you can look at it in many different ways, and it has to be carefully calibrated and coordinated with all the other issues and all the other issues that we are looking into presently, because also you need to reflect on what is the future capital adequacy level supposed to be. How much capital are the banks supposed to hold? What kind of liquidity rules will we have in the future? And then if you add various ways of sort of financing bank rescues on that, being it a levy or a tax or whichever word you choose to use, the key issue is really to put together a package which is consistent and logical. And there, in that context, the tax might show up or it might not show up. It's a bit early to tell.
Do you think? Would you agree that being a central bank governor in a country that's relatively more stable, where the interplay between the different institutions, the central bank, the government itself, and the FSA or the prudential regulator is relatively transparent, stable, that you are more amiable to a bank tax than a central bank governor in a country where the relationship is not stable?
Well, that's not for me to judge. We already have a stabilization fund which is being organized by the government, and that fund is very closely actually related to our deposit insurance system. But clearly, when you do these things, it's helpful if you can explain to the general public what you're doing, and it's also very helpful if these types of systems are properly audited. And that they are transparent in such a way that people actually can understand what is going on.
How would you describe the relationship between the different pillars of the Swedish economy? Not relative, but for yourself in a sense?
Well, very standard in the sense that we, as the central bank, we provide banks with liquidity if there is a need for liquidity, and we lend to banks against collateral. But if the whole issue ends up being a solvency issue, then that has to be dealt with by the deposit insurance agency / in our case the National Debt Office, because that's where those kind of issues are dealt with. And then we also have the financial supervisory agency, the FSA, and it's basically up to the FSA to deal with the solvency issue to determine whether a bank is solvent or not.
Right. Is there a continued need for a National Debt Office if the resolution mechanism, it's taken over more by the government?
Okay, that's a matter of choice, and this clearly varies from country to country. If you have in a large economy with with many banks, then normally there is a need for a resolution agency of one form or the other. Let's say what comes to mind is of course most often the FDIC in the US. If you have a fairly concentrated banking sector as we have, and if we have a debt office which manages the government's debt, and it's quite unlikely that you say yearly have banks in difficulties, then you need to locate a resolution agency somewhere on the public sector side. And in our case, we just found it most convenient to have the debt office dealing with it. It certainly is not, as far as I look at it, an issue for the central bank to deal with.